Shares of Host Hotels and Resorts are slightly up right now after reporting fourth quarter results that came in better than expected. Joining us now is Jim Risoleo, CEO of Host Hotels and Resorts. And Jim, it's great to have you back on the show. And that's exactly where I'm going to start with you. You put up stronger than expected results for the fourth quarter. But in terms of your 2025 outlook, the total RevPAR growth of 1% to 3%, what is driving that? And perhaps just as importantly, what does the picture say with the EPS guidance about expenses versus growth this year?
Sure, Morgan, it's great to be back. Thank you for having me. So we did. Let me start with 2024. We had a fantastic 2024, beating all consensus metrics, and I think the company is set up very well for 2025 and beyond. What we had in 2024 that's going to impact the operating statement in 25 are a lot of one-time events. We had hurricanes in Florida, Hurricane Helene, Hurricane Milton. We were lapping the wildfires in Maui. And for 2025, we're going to have a fairly significant increase in wages and benefits across the portfolio. We think this is a one-year phenomenon, and that as we work our way through 2025, that our performance will improve in 26, and frankly, even as the year unfolds. It's a little early in the year right now to really drill down on guidance levels.
Okay. So when I look at your portfolio, I mean, you have quite a few properties across quite a few major cities, and also, I would say, leisure centers. You tend to be more skewed looking at these properties to, I would say, a higher end consumer or business traveler. What are you seeing in terms of travel appetites right now, and what does it say about the health of the consumer?
Well, the consumer is very healthy. Our consumer, the affluent consumer, is very healthy. We continue to see increases in out-of-room spend, ancillary revenues, whether that's outlet revenues, revenues at the spa, revenues for golf. Consumers are showing up at our properties, and they're spending money. Our leisure transient rate for 2024 was still 44% higher than it was in 2019. So we're not seeing a lot of resistance of the consumer spending money. And in point of fact, given the quality of the assets that we have, when the consumer visits one of our properties, they tend to stay longer, and they tend to spend more money in the bars, in the restaurants, and elsewhere.
Jim, two things in particular I'm curious about as we're now in 2025, how they look right now and then into the year. One is business mix, and the other is international demand, given the strong dollar.
Sure. Well, business mix, we're going to be about 60% transient this year, John, 36% group. The balance will be contract business. It's fairly consistent with how the portfolio has been positioned over the last several years. Of the 60% transient business, roughly 60% of that is business transient. And we are seeing a slow, steady rebound in spending by the business traveler. So we saw an uptick last year. We're anticipating we'll see an uptick this year. Our group segment is very strong. We're pacing well ahead where we were last year at this time, and we feel very confident with the health of the group customer. We continue to see group spend out of room increasing on a regular basis. The leisure customer, this goes to your question about international travel. There is an international inbound versus international outbound imbalance. And right now, it's about 125% elevated international outbound and international inbound. While that's improving, it's still not where it was pre-pandemic levels. We think a lot of that has to do with the strong dollar. We believe that, again, our consumers, our customers, or the affluent consumers, they want to experience other jurisdictions outside of the U.S., but the pendulum is going to definitely swing back to the middle.